hear a little bit more about Harvest and what we do. I've just got 25 minutes, so there's not a lot of time to drill down deep, but I want to sort of hit the highlights, and my goal is to have follow-up conversations with those who are most interested. So, as Marty mentioned, we launched Harvest in April of 2008. So, our first strategy was a net short vol strategy just before the financial crisis, which was pretty awesome. But that actually, as challenging as that was, we finished the year up, and when you can live through something like that and be able to talk about the experience, not a back test, but the actual experience, and obviously that was very helpful. Everything we do is option related, and everything we do is liquid. Everything we do has total transparency, daily liquidity, no lockup, and because we generally just trade SPX, broad-based index options, we also get the favorable Section 1256 tax treatment. So, but ultimately what we're trying to do is either add yield to your portfolio, help you take risk out of your portfolio, or help to deliver alternative sources of income, which is very topical, and even alternative sources of data. And those are some things we'll talk about today. Thank you, Marty. If you go to slide 2, just quickly, as we mentioned, we launched the firm in 2008. We're based here in New York, although I must admit, this is my second trip to New York since February of last year. So hanging out rings has not been pleasant, but the fact that we've proven that we've been able to run the firm and communicate with clients and prospects, et cetera, remotely and using all the technology that a lot of people have been talking about today has been a real benefit. Marty also mentioned we're managing just under $5 billion. We've also we've seeded and spun out a couple of different groups along the way as well. So, Julian Robertson has his Tiger Cubs, and we like to talk about the Harvest Acorn. So, we like to use our platform to help firms get growing and share in their success once we spin them up. So, when I think about the challenges facing investors, if we go to the next slide here, every one of us is grappling, if not all, at least one, if not all of these. How do we add yield to our portfolio in this historically low rate environment, especially a rate environment where most people think rates will be higher 3 to 5 years from now rather than lower? How do you consider alternatives without paying too much in fees and giving up too much as far as liquidity and transparency? How can we use options to help solve some of our problems if that's not our core competence? As Lisa mentioned earlier, you want to work with experts, people who deal in whatever it is they deal with 24/7. Another one is if you're underweight equities, how do you thoughtfully add equity exposure without trying to time the market? Or a similar related one is if your equity allocation is already at target, but you're nervous about that future 5, 10, 20% pullback that we get every couple of years. And we've been lucky so far in that those pullbacks have been sharp, but the V-shaped bounces have been even sharper. What happens if we don't get that sharp V-shaped bounces, and how do we deal with that? And then ultimately, how do you beat the benchmark fees and improve the risk return? So everything we do is focused on those things and helping clients, helping advisors meet their objectives. So if you go to the next slide, we really have 2 different types of strategies. One are overlays, and the benefit of an overlay strategy is we're trying to deliver returns to you without you having to deliver capital to us. And so it's like having a home equity line of credit that as long as you don't draw on that credit, you don't pay for it. And so we effectively have a home equity line of credit on your margin account. That allows us to run our strategies, but our goal is to not ever have to draw on that account. So if we can get you incremental return without you having to redeploy capital, that becomes pretty interesting. And up here, the first strategy, the cloud yield enhancement strategy, that is effectively a portable alpha strategy, right? So we're just trying to add 1.5%, 2% net of fees on top of your portfolio. But if you've got a 60-40 portfolio, and And that portfolio is targeting 68%. Over time, if we can add 1.5 to 2% on top of that, that's a meaningful pickup. It's all cash, it's tax efficient cash, and it gives you the flexibility to then be able to reinvest that cash or to live off of that cash in a yield-starved world, or to help have that cash help meet your philanthropic and giving needs. So if you're a foundation, you need to give away 5%, and you don't want to dip into the corpus, we can help you. So that strategy is, it's basically running iron condors on the S&P 500. And for those who want to know the term iron condor, we sell short-dated out-of-the-money call spreads on the S&P premium with limited risk, and we sell short-dated out-of-the-money put spreads in the S&P premium with limited risk. And we're trying to take advantage of the vol risk premium, which is sort of like an insurance analogy, but we're also trying to take advantage of time. And that basket of options is actively managed. So very interesting strategy for those looking to add a little bit of yield, portable alpha on top of a portfolio that they're already very happy with. Our second overlay, and actually if you will see on the slide, the middle column, the dynamic delta overlay strategy, that is meant to be a replacement for some or all of the 60 in your 60-40. To us, this is a better way to get equity exposure in that the risk-adjusted returns have been better than the S&P over time. You've got downside hedges to address the concern about that potential pullback, but we've got unlimited upside, so you're not capping yourself like most hedged equity exposure and strategies. But we're giving you that hedged equity exposure without capital requirement, which that frees up that capital for you to put into other alternatives, other investments that might be higher yielding, that might be less volatile, that might be less risky, that might be less correlated, even less liquid. So for some of these great private equity and venture ideas that we've heard about, if you've got clients who are fully invested, you can use a DDoS overlay to replace some of that equity exposure, give you better returns over time, but then redeploy this capital in other things. So the ultimate point is that DDoS gives you a lot of flexibility. It's a great tool for families, for advisors, for individual investors to use as an alternative to their liquid equity, which liquid equity still remains probably the largest investment in most client portfolios. We'll drill down on that as the biggest part of today's talk. The last thing I want to mention is the nationwide risk managed income ETF. And I mention that because Harvest is the manager and sub-advisor of that strategy. So we partner with Nationwide Insurance, we split fees. That strategy, and it's an ETF, you can look it up on your phone. The ticker is NUSI. We launched it just about 2 years ago, and seeded with 20 million. We just crossed the 850 million mark. It's one of the fastest growing ETFs out there, one of the most successful. It's certainly the most successful launch that Nationwide's ever had, and we're very proud of it. And what that strategy is we're long the NASDAQ, and each month we sell a slightly out of the money call on the NASDAQ to collect a lot of premium. We spend about half that premium to buy a protective put. So we're putting bubble wrap around the NASDAQ and trying to generate a yield of about 7.75%. You still have a little upside on the NASDAQ, you still have dividends on the NASDAQ. The combination of that premium with the little upside with the yield. Now you don't buy this in lieu of buying the NASDAQ because you're not going to get the same level of upside. If the NASDAQ is up 40%, this is not going to be up 40%. This is in lieu of MLPs, REITs, high yield, other investment. For anybody who's concerned about interest rates and how low they are and where they're likely to go, those who are concerned about credit spreads, those who are concerned about sector-specific risk, this helps to address all of those things. Last year, the strategy was up 18.6%. This year, through November, it was up 10, 11, and as of 2 o'clock today, or as of right now, it's up about 12% year to date. So very interesting. NUSI is the ticker, and I just mentioned that because it's just so interesting given the challenges facing investors and those who look at the 40 of the 60-40 portfolio and say, I'm not really keen to own bonds. What are some other things we can do? Thanks, Marty. Alternatives to reduce portfolio volatility, I'm going to skip over these. My point here is that DDoS seeks to help in each of those things. If we jump to the next, what is DDoS? It's a more capital efficient way for you to get equity exposure with actively managed hedges. And if we can sort of try to keep up with the S&P when it's up and always outperform when it's down, that gives you a pretty high class outcome. One thing that you all, I'm sure, know is that volatility is the enemy of compounded returns, right? So if you've got $100 and you're down 50%, and then you're up 50%, well, 100 goes to 50, and up 50, you're at $75, right? If you can be down 10 and then up 10 instead, 100 goes to 90, up 10 goes to 99. So the point is if we can help take some vol out, give you similar returns with lower vol, you're going to be better off over time. And that's a big part of what DDoS does. The next slide, what is DDoS? And by the way, all of these strategies are in your own account, right? So you're not commingled with anybody else. It's not a fund. These are separately managed accounts. We manage everybody the same way, same time. We do one trade and everybody gets the same positions. But ultimately, if you were to buy spiders, for example, you are by definition long 100 deltas, right? Delta is a measure of how much do I make if the market goes up $1 or down $1, right? So if you own spiders, if the market's up $1, you make $1. If the market's down $1, you lose $1. You're always long 100. And we think getting you that delta exposure using options, and we'll talk about the 6 main benefits of DDoS versus the S&P versus spiders versus any other, S&P index fund or any equity fund that's trying to benchmark the S&P. But you can get long delta by either selling puts or by buying calls. And we do both, and we do both in a very thoughtful way. Marty, I'm going to actually have you jump ahead, if you don't mind. I have to reorder these slides for my next talk. But if you wouldn't mind going to page 11.
Alternative DDoS?
One more.
DDoS seats?
Right here, right? So page 12, and how much time we got, Marty? About
you got about 10, 15 minutes.
Okay, very good. All right, so ultimately, what is DDoS and what's it trying to do? It's trying to take advantage of these 6 things that you do not get when you buy spiders or when you're on the S&P. First is option skew, right? So option skew is a measure of the relative richness of downside puts versus the relative cheapness of upside calls. And most hedged equity strategies, or most investors, they might be long the market and they want to protect themselves. They buy downside puts and they finance the purchase of those downside puts by selling upside calls. And that helps to deliver what's called skew. The other reason that skew exists is the market tends to take the stairs up and the elevator down. So that combination of things, when people talk about the VIX, which is 30-day sort of composite implied volatility on the S&P, if the VIX is at 20, those downside 25 delta puts are probably trading at 25 vol, and those upside 15 delta calls are at 15 vol. So what most investors do is they pay 25 for their protection and they receive 15 to help, they cap the upside, but they're helping pay for something. They're paying away 10 vol points of negative VIG, all right? And that just struck me as, I want to do the opposite than what we do with DDoS. It's the opposite. We're not long the market. We're getting you delta exposure by selling those downside puts at 25 and buying those cheap upside calls at 15. So instead of paying away 10 vol points to take risk out of the S&P, we're creating S&P exposure of getting paid 10 vol points. So that's point one. The skew is tremendously powerful. It's persistent 100% of the time. It's not there most of the time. It's there 100% of the time. Right? So option skew is a huge advantage. The second thing is we want to give you asymmetric risk reward. Who doesn't want asymmetric risk reward? We want to give you unlimited upside with capped limited downside. How do we do that? Well, when we sell those downside puts, we sell put spreads, right? So we sell the really rich puts to collect a lot of premium, and we buy further out of the money cheaper puts to limit our risks. So we're effectively saying, hey, we'll buy the market if it dips, but we've always got bubble wrap beneath us. We can afford to do that because of skew, right? So we're getting paid so much for selling those puts, we can afford to buy the protection below it. So we only sell put spreads with finite limited risk to the downside to give us equity exposure, but we're also buying calls with unlimited upside. So if we can take advantage of skew and give you asymmetric risk reward, sort of that hockey stick diagram outcome over time, that's a tremendous benefit. The third benefit is taking advantage of option timing, right? So take advantage of the calendar. And what we mean by that is options decay in a non-linear fashion, right? So shorter dated options decay more rapidly than longer dated options. When we sell those shorter dated put spreads, they're 1 week, 2 week, 3 week, and every week we're replacing them. As they decay, we're selling again and bringing in more premium, more premium, more premium. The longer dated calls that we buy are 3 to 4 months out. So when I say we're taking advantage of calendar time decay, we're earning more in decay by selling short dated put spreads than we're bleeding decay in those longer dated calls. And by the way, when those longer dated calls get to about the 2 month mark, we roll them back out, so they never get to that point where they really start to slide down the curve. So in a steady state fashion, when the market's sidewinding, we're still earning time decay, which is again helping us to outperform the S&P over time.
So one of the bonds with all vol funds is that they have that kind of choppiness, and so you're saying you're eliminating a lot of the choppiness.
We like chop.
Okay.
We prefer the chop. And part of what we're doing is we're saying we will definitively lose less when the market's down. And we're going to do better when the market's sideways, and we're going to try like heck to keep up when the market.
Right. So we've had CTAs who've come to our company and said, well, we lose money, 90% of the year, but then we have a great 10% of the year.
Yeah.
Is that similar or no?
No.
Because
we're highly correlated with the S&P, but our negative months are much less negative.
Got
Ours are the months that come closer. So if we're sort of a 90 of the up and 60 of the down, if I had to give you sort of a back on board answer. The fourth point that we're taking advantage of is that this strategy is actually net long volatility. So even though we're earning time decay, we're actually net long vol. And as you probably know, the VIX is negatively correlated to the S&P. So by definition, if you can add something that's negatively correlated to your portfolio, it's the perfect add. Problem is you can't buy stock VIX. And if you try to trade VIX futures, there's contango and there's all kinds of things that are a challenge. We're giving you this long vol exposure without having to do it. And how do we get that? Well, the long vol exposure in our longer dated long calls is greater than the short vol exposure in our short dated put spreads. So the benefit is we're earning time decay, which is good, but we're also net long vol. So when the market's down, vol isn't up a little, vol is up a lot. And that is another source of protection, if you will, for the strategy. The fifth is base delta targets, right? So if the VIX, if you think about the VIX long term, which is a mean reverting metric, it's not something that increases over time or decreases over time. It's something that is sort of migrates around 20, which is its long-term average. And if you take a VIX in the 16 to 24 range, which happens about 38% of the time, I'm agnostic as to where I get my deltas on the short put spreads out of the long call side. So I'm okay if I get sort of 50 on half on one side, 50 on the other. When the market sells up and vol explodes, right? So call it 24 to 30 as being high vol. That happens about 15% of the time. When vol is high, I'm okay selling more of it, especially because it's after we've had a big decline in the S&P. Okay, we're willing to sell more put spreads and get more of our delta from the put spread side because we've had a favorable move and we're taking advantage of a mean reverting thing that we know is going to come back. And then frankly, when the VIX is above 30, which happens about 8% of the time, very extraordinary, and doesn't last for long, it does happen, we're okay almost doing any net short put spread strategy. We're getting the majority of our delta from the put spread side. When you go the other direction, and the market hasn't had a 3 to 5% pullback in a while, and we've all gotten a little bit complacent, and the VIX is declining. Well, when it gets into that 12 to 16 range, which I would call low vol, I'm less keen to be selling put spreads in a market that hasn't had a pullback in a while, and vol is cheap. And so we're getting more of our delta from the long call side because vol is cheap and we have a pullback. And by the way, if the market keeps running, we're long calls, so okay, we're making money. And then when the VIX is below 12, which happens very infrequently, 10% of the time, we're almost in stock replacement mode at that point. Calls are so cheap. It's so cheap to just be long calls that we're going to get most of our deltas from the long call side because we know that a 3 to 5 to 7% pullback, it's not a question of if it's going to happen, it's a question of when, and we would prepare for that. So the net bottom line of 25 is that when vol is rich, we sell more, and when vol is cheap, we sell less. And we take advantage of that maneuvering aspect of VIX. Finally, number 6, active risk management, which again, you don't get any of these things if you buy spiders or you buy any index fund or you buy any manager who manages the S&P as a benchmark. Because these put spreads are decaying every week, we're losing deltas, so I get to replace deltas. And what we get to do is on rallies, we get to trim some deltas, and on pullbacks, we can add deltas, and on rallies, we can trim it. So, hey, we can take advantage of the chop. So, Marty asked a question earlier about volatility. We love volatility in this strategy. Because when the market's down, vol spikes, so put spreads, market rallies, market's cheap, put spreads vaporize, and then we replace them again. So, we like the chop. The other thing we can do is in front of known unknown events, whether that is non-farm payrolls or a big Fed meeting or announcement like next Wednesday, or a big election. We have the ability to reduce exposure on the put spread side so that if we're long calls and the market likes the outcome and takes off, great, we're making money from our long calls. But if the opposite happens and all of a sudden we go back, we've got very little exposure to the downside. The exposure we have is very tight. We can do that kind of active risk management in this strategy, which you can't do if you're long, just perpetually long. So those are all benefits.
5 minutes.
Great. Let's, Marty, if you don't mind, I'd love to go, I'm going to point to a couple of things. One, let's go to page, let's go to page 8, which is just the returns. And those are too small for you to see, but what I will tell you is that since we launched almost 6 years ago, the returns have been right in line with the S&P. The negative months, we've been down less. The positive months, we've down a little bit less. But the net result is that even though our delta only averages about 70, and we have downside hedges, and we're net long vol, if we can give you similar S&P exposure over time with less risk, less vol, less drawdowns, quick recoveries, and no capital requirement, that becomes pretty compelling, right? So I want to just give you 2 quick case studies. If we go, Marty, to the next page. 2 clients sold their business, and they each walked away with $10 million after tax. They walk into your office, or they walk into your living room, whatever. They set their bag down, and they say, what are we going to do with this dough? And the first client says, I'm going to keep it simple, 60-40, I want to put 6 million in spiders, I'm going to put 4 million in ag. And over time, I might change that mix, but for now, I'm going to go 6 million in spiders, 4 million in ag, and call it a day. And they got their 10 million at work, and they've got 60 in equities and 40 in bonds. So the second client heard this talk and said, why would I put any money in spiders if I could put money in DDoS? So I'm going to put all 10 into DDoS. And I'm going to run the DDoS overlay on top for 10. So what I've got is 0 in spiders, 10 in ag, and then 10 in DDoS. So effectively 20 million working instead of 10. And actually a lower percentage of equity exposure, you're 50-50 instead of 60-40. And that equity exposure, even though it's larger, it's got a hedge component to it. So let's see how we do. So we go to the next day, and since January 16, go to page 10. There we go. You can see in case 1, hey, annualized return for the 60-40 has been 11.54%. Pretty incredible. Thank you, equity market, and thank you, bond market. Interest rates drop and equity markets go up, and it's win-win. So 11.54 annualized return, standard sharp above 1, Sortino above 2, all good stuff. Well, case number 2, annualized at 1838, so 684 basis points per annum of outperformance. Higher Sharpe, higher Sortino, higher information ratio. Just incredible that without any addition.
I don't know what the DOS is.
Oops. So now there are an infinite number of other ways you can do this, and we help you with that. But this is just one illustration. And by the way, for those who say, yeah, Rick, but I'm not really keen to put any money in ag because I'm really not keen on the bond market.
The barberia, the guy is open. The barber shop is paying 4,000.
There you go. Sorry.
That's a vote.
Then we can put that money into other hedged equity or short duration fixed income, short duration high yield, short duration emerging market bonds, et cetera. So we do that and can help you advise on that as well. So that is sort of the high level introduction to Harvest, introduction to our overlay suite, introduction to our risk managed income ETF that we manage under the Nationwide brand. But then this DDoS strategy, which to us is a real game changer, and no one else is doing anything like it. We're early, which is good and bad, but
How much is the DDoS right now?
we're just under 50 million in this strategy.
Okay.
But this is the one that I'm most excited about. We took our the original sort of iron condor to a multi-billion-dollar strategy. We think this is going to be right in line with that. So.
Great. Any questions on this or on vol? Can you just, actually, I wanted to get kind of like a global macro view on vol. There's so much stuff happening in volatility right now in terms of like China, the Fed, et cetera. And I think the reality is I think Bitcoin has really like sucked up a lot of that vol because when people are doing bad in China, they throw their money out into Bitcoin, et cetera. But I mean, this is some real global macro stuff going on. I was hoping you could talk around the vol and all of that.
Vol is going to be driven by volatility in the S&P. And I think when we have a Fed that's about to take the punch bowl away from the party, when you have the amount of uncertainty we have, whether it's China, whether it's Russia, whether it's North Korea, I think there are so many reasons for us to be nervous, so many reasons for. And when you've had a run like we've had, an unmitigated run, other than obviously the 35% pullback during COVID, which came and went. And with interest rates so low, so many people have been buying stocks because there is no alternative, right? Stocks only go up and there is no alternative. Well, at some point when that music stops, it's going to be dicey. So my view is vol is going to remain high. I think the vol risk premium is going to be frothy. All of those things for our strategy.
And how does, I'm sorry, just one quick question. How does vol perform when rates go up?
Well, presumably rates go up, equities go down. If that's the case, vol will go up. Or when rates go up and equities struggle, in which case vol is still going to be elevated. So I just don't see us at a point like we saw so much since 2010, where we had the VIX in the low teens. We just don't see us getting to that point anytime soon. It's just too much on the horizon, too many things changing, too much uncertainty in the air. So I think vol is here to stay for the foreseeable future.
George, you had a question?
Yeah, you say that you adjust the positions based on an upcoming event, an election or something like that. And you're also offering daily liquidity.
Yep.
So what's the term on the options that you're doing? And how far out do you go?
The options that we're writing, the put spreads that we're writing are typically out 1 to 3 weeks. Calls that we're buying are typically out 3 to 4 months. But SPX index options trade as well, right? So we can, if you want to close your position at 211, we close your position at 211. If you want to increase your position at 315, we can increase your position at 315. So the point is this is the deepest, most liquid market on the planet, and so we have the ability to transact intraday accurately.